Ladies and gentlemen, welcome to Creating Tailwinds Podcast by Flight Path Financial with your hosts, John Urbick and Jared Adams. Join us today as we discuss the power of infinite banking. And here we go. Ladies and gentlemen, welcome to our most current episode of Flight Path Financial's Creating Tailwinds. We're here with our wonderful guest, a wealth of information, Gina Wells with Financial Design Strategies, and Jared Adams. And we are just so happy that you're here, Gina, and thank you for taking the time to be with us today.
You're welcome. Now, is Jared flying a plane in the back seat of a car? What is he doing there, Jared?
We've got I'm flying low, which means I'm driving as fast as possible. It's the only thing I know how to do. And I happen to be in my slick little Tesla that's driving for me so that I can pay attention to this awesome conversation.
Awesome.
Jared is on assignment.
There you go.
Investigative reporting.
There you go.
But yeah, so anyway, Gina, we always talk about the problem and solution in infinite banking. That was Nelson's thing. What's the problem? What's the solution? The lack of current cash flow and lack of money in the future. So many people suffer from those things. So what's the answer? As an infinite banking practitioner, say become your own banker. Mm-hmm. That is the solution. It's not hard. Mm-hmm. But when we spoke earlier, you talked about what you meant by referring to funding today to ensure buying at a discount tomorrow.
Yeah. Yeah. Well, a lot of people don't even think about savings. And so when we talk about the problems, right, the number one is the human element. We get a paycheck, we spend our money, we think we don't have anything left, and we wait in time to catch up. And the longer we wait to start saving, the more we need to catch up. And so cash value life insurance and the infinite possibilities of it, speaking of what we were talking about earlier here for my mother, in fact, when my parents set to retire, my dad had 30 years with General Motors, had a great pension. They had a beautiful home that was paid for in Michigan on a lake, and they wanted to buy a home in Florida to live on. So my dad's grand idea was to liquidate his 401k to buy that property in Florida. Now, granted, I used to be a paralegal. I was not a financial advisor 32 years ago. And we're talking, I was probably 5 years into my career, and what my dad saw me as was a life insurance agent. Who wants to buy life insurance from a life insurance agent? He didn't know what I knew. And so I said, Dad, we're going to talk. I want you to sit down, and you're going to talk to me like I'm a professional. I'm not your daughter, right? We're going to talk about what, if you liquidate this 401k to buy the real estate, what that's going to do to your 401k and to the real estate. So once I explained it to him, the number one thing he didn't know to be true was it would all be taxable. Uh-huh. He did not think his $500,000 in a 401k that he had amassed, right, would be $500,000. If he liquidated it all, he'd be in the highest tax bracket. He didn't even realize that. So once we got through talking about that, he realized by leveraging his real estate in Michigan to buy the real estate in Florida was a good thing. Now, at the same time, we tried to get life insurance on him, and that was a point in time where he was uninsurable, and he passed 1 year into his retirement. But the way we set things up for my mother, who is now 85 and healthier, you would think she's 70, maybe, 63 like me. I don't know. She's in great health. But so now she's set up to move and do what she wants to do, right? Why? Because she made a plan with cash value life insurance. And we've utilized that cash value life insurance over the past 20 years for many things. Buying a car, buying the house she's in right now that's helping her to get into the CCRC. So there's loans on her policies right now, right? And she worries, what, do I got to pay these loans back? Right? No, Mom. They'll be paid back one day. When the Lord comes to take you off this earth, they will be paid back.
What a great feeling. At a discount. What a great feeling, though. What a liberating feeling to know that you can access that capital on your terms and you don't have to pay it back
Yeah.
now. That's awesome.
Now I will tell you this, because when she moves to the CCRC, there is, if you guys know anything about that, there are communities for people who have planned adequately, right?
Mm-hmm.
She never bought long-term care insurance, but what my sisters and I did about, well, probably 20 years ago, was the three of us own a policy on her so she would never, have to show that that was her ownership. So we own this one policy of cash value that won't show up on her asset statement. That would have been for her long-term care, possibly, if she ever needed it. But now, when she invests in the CCRC, she's paying a monthly fee, which is about $1,000 more than it cost her to maintain this house right here.
Yes.
And so she's going to be eating up some of her assets, but not all of her assets. But she's going to have everything that she needs, right? And long-term care will move right into this. So just on a quick note, talking about at a discount, and this sounds crazy, but she's going to give a great deal of money, the value of this house, to buy into a condo in the CCRC. She'll have everything that she wants. She'll pay a monthly fee to live there, about $3,800 a month to live there.
Right.
Inside of that is $500 for all the restaurants and things that they've got. We found out today that if she wants wine for dinner, she can bring her own wine. She doesn't have to buy theirs.
Do they card her there?
I mean, it's just a professional place. It's called Emerson Lakes, by the way, here in Sarasota, Florida.
Oh, sounds
And
like a
it's
wonderful
brand new
place.
facility, super brand new facility. She's buying in ground level here, so she's getting a brand new place to live. But as we looked at that monthly fee is going to go up with inflation, right? And if she were to live to be 110 years old, she could. My grandparents lived to be 100. She's 86 and in great health, as I said.
Wow.
We don't know our longevity.
Wonderful.
But let's say that she spent all of the money left over for her care. It would be right there in her, in her place. She'll buy to have people come and take care of her right there. So it's in-home care, essentially.
Yeah. Yeah.
And if she ran out of money for paying for that, then they will eat up the deposit that she made. And if they eat up that deposit and she's still living, that's a guarantee that she'll always have care. So
they
long-term
must have
care,
an annuity built into this whole complex for those contingencies.
It's like long-term care with continuation of, a continuation of benefits rider for lifetime payout to give you a sum of money. But this is more than a sum of money, and it's unique. Right? So there are unique things. And so, coming back to at a discount of whatever we may do in life, everybody's situation is different.
Sure it is.
I mean, my mom is unique. There are other people like her, obviously, because this place is packed with healthy seniors who play pickleball and swim and golf and, do all these things, but probably don't have a family or don't want to use their, they have a family, don't get me wrong, but they want to be safe in their end of year life.
How many people do you think are not planning for long-term care?
A lot.
Yeah. And
it's just like a lot of young people who aren't planning for their next 10 years.
Exactly. So since you went into that, and I think it's a wonderful topic, what can people do, whether they're 30 or 60 or 70, that are looking at these situations? How can they implement infinite banking, the infinite banking concept, into their life so that they can address some of these issues head on?
I think the first thing is for all of us is to overcome our personal things, right? We spend too much money, Parkinson's law. We put off things until the last minute. We have to overcome the human elements is the first step. And we have to sit and think realistically, do we need this? Now we think about it nowadays when I was looking at things that she pays for here at her house, lawn care, pool care, all of these different things that she pays for. She won't need that there. That's all kind of paid for over there. But she can afford to do it because she saved up to do it. Now, when somebody is having those things, lawn care, pool care, all of that, and they can't afford to do it, right? That maybe they should take a Saturday and go and mow their lawn, or do something of that nature to save what they would have spent that they really can't afford to spend. So I think it starts with our human actions. We finance everything we buy,
Yes.
right? And the amount of housing costs, the amount of lifestyle costs, the amount of interest costs that we pay, even for things that may not have an interest cost to it. For example, buying services that we could do for ourselves because we don't want to.
Well, and there was one other thing in there that was not included in Nelson's book. Remember, there was Willie Sutton's law, there was Parkinson's law. I don't think he included the Joneses law. That keeping up with the Joneses, that's a big one. Overspending, thinking what other people care about you or think about you matters. That one needs to be included in the next version of the book.
That's very true, especially when you're driving around or letting the Tesla drive you around. Now, I'm not going to keep up with that Jones, Jared. Although I will tell you this, that we just bought a truck and it has Blue Cruise. I've never experienced Blue Cruise.
I bought this vehicle because I was doing like a more regular commute about 30, 40 miles away. And when they said, hey, you're done with that commute, it's time to figure out, would you like to sell that vehicle or not? I said, I can't. I have to have this vehicle. This is the most fun vehicle I've ever drove. So, yeah, we'll talk about maybe some other podcasts as to how I finance this through my own infinite banking policy.
Exactly. I hear you, Jared. I finance mine too because the luxury once enjoyed is not going to be given up.
It's kind of the way it goes, right? But luckily, it's well within our wheelhouse. It was well within our family's plan. It all worked, but we're very blessed.
And therein lies the secret, Jared, is the plan. It is not affecting your future. We all at the think tank think long term. So that Tesla thinking long term will be replaced with cash value and death benefit. Net death benefit, you bought it at a discount against your net death benefit.
So Gina, why then is IBC more important today than ever? Why IBC? For those that don't really have an exposure to it.
Well, let's talk about infinite, right? Mm-hmm. There's infinite possibilities. You are, as long as you're on this earth, you're not infinitely on this earth, but while you're on this earth, you will always be needing money to buy something. And again, going back to the lifestyle and going, okay, what is a part of our lifestyle that I need and what is a part that I want? And are my wants getting in control of my needs? So for example, if you're not saving that 20% right now and budgeting around there, that's a problem. Any young person needs to be saving that 20%. Now, where do they save that 20%? Lots of places. There's lots of financial noise out there, right? Why would anybody put money in a life insurance policy? You're so stupid to do that, they say. But the reality is, myself, who started young, there's a little bit of my story on my website, www.yourfds.com, is that when I started with a policy and they told me to save $50 a month. Save $50 a month, and this is going to be there in the event of your death, and your daughter will be able to go to college. It was a $50,000 death benefit back then. And I was 22, so over 40 years ago. That policy has built into a greater death benefit than 50, and that money has gone a long way. I have reused a dollar more than once for so many things. And once I realized what this policy that I bought was, because I wasn't a financial advisor back then, I was a paralegal.
Yes.
But once I realized what it could do, and I started studying with Nelson back in 2004, and I started studying with him and really hearing the message of, you don't need the stock market, you don't need Bitcoin, you don't need gold and silver. All of those things are going to have to be cashed in for our useless dollar. We've got to buy. You can't pay your mortgage with gold and silver. Might be able to pay it with Bitcoin, but you'll liquidate that to do so. And those are debts, a mortgage, for example, college, right? Those cars, big medical expenses, things that we save to spend for but we really don't know when we're going to have to spend. And when we have to spend, we have to figure out, are we going to borrow it? Are we going to take it out of our bank savings? Are we going to take it out of a 401k IRA? Are we going to take it out of a stock portfolio? Or can we leverage it from our policy, pay it back to ourselves over time, and have that dollar to reuse again? That measurement of rate of return is called velocity of a dollar.
Yes.
And it is so much more important than rate of return on any other type of investment, right? Because life insurance is not an investment. It is a savings, and it is a capital purchase on your life.
Right.
Everything you do will revolve around it.
So for the people out there listening, you say, this sounds great, but I don't have any money. Where do they find the money?
Well, I say people are unknowingly and unnecessarily throwing away money on many different things that they're doing. And so in my practice, I take a look at where all cash flows are going. Starts with your tax return, with your pay stub, with your actual investment statements and your actual debt statements. A lot of people will say to me, oh, well, I owe $7,000 in credit card debt. Do you know what interest rate? No. What's your payment? Well, I pay like $300 a month. So it's arbitrary, right? So then
Yes.
I wanted them to look at that statement. I want to look at it with them. Here's your credit ceiling, right?
Yeah.
If you go over your credit ceiling, guess what? There's a cost to that. Your credit score, one. But there may be a $50 cost or whatever it may be. Let's say that they're putting $4,000 a month on for lifestyle expenses and only paying 60% of what they bought. Then they're overspending. And we have a conversation. Why are you overspending? What happened here? Was it a weird thing because you needed tires on your car, an air conditioner replaced, whatever? Or are you purchasing things that are hindering you from your future? And so I call it a lifestyle ceiling, right? If your lifestyle ceiling is impeding your rooftop, you're going to have a leak forever. You're never going to get it fixed. So you got to fix it at the ground level. Just like you guys when you get ready to fly your airplanes. And my husband used to be a pilot, so I know a little bit about checking out the airplane before it takes off. Making sure that everything is in working order. That's the first step, is to make sure that what you're doing is going to lead to a future, right? So if you know your kids are 5 and 6 years old, or however, and you're going to pay for college, or you're not going to pay for college, whatever may be the case, you're going to need capital when they're 18, 20, 25 years old to possibly help them or not help them. But at least you'll have made a possibility in the future for you to help them if you wanted to. And granted, they should learn about money along the way.
But I have competing places for this money, right? I'm the objector out there and say, well, okay, I don't get a rate of return at all inside my life insurance contract. Why should I do it? How would you explain that to people, that it's not about the rate of return? And you already have, in part.
I would say just that you're measuring the wrong thing. What is it?
Bingo.
I would ask them, what is the rate? What do you want as a rate of return? And what do you want that rate of return to do for you? So let's suppose you're in a stock portfolio. You put $100,000 in there, and it gave you a rate of return in 1 year of 8%, and you have $8,000, and you're like, woo, I got a rate of return, $8,000 is awesome. And the next year you wake up and you have a negative rate of return of 10%.
Right.
And now you've eaten into your capital. How long will it take you to get back? What kind of rate of return are you going to need to get to where you should have been had the stock market never dropped or had your investment never lost money? And in a life insurance policy, if you leverage, your policy is on a trajectory to move forward.
Right.
Let's just talk about moving forward. Let's replace rate of return with moving forward and thinking long term and knowing that you get, I go this way, you get out here and you got all this cash, right?
Well, I was going to ask Jared, when my Tesla stock, which is down, when does that reflect this? I'm making all this money on Tesla. I haven't lost a nickel on any of my life insurance contracts, not a penny.
Well, the other thing that we've talked about before is that we always put the three different classifications of the rate of return, right? You've got an internal rate of return inside the policy, the external rate of return when you put it to use, and then the eternal rate of return when you actually get paid back at the time that you graduate. So when you can put all three of those together and come up with a number, then tell me how that compares to your stock portfolio.
Touchdown.
Yay! Yes.
Touchdown. Love that.
Yeah.
Great explanation.
Mm-hmm.
Well, so what about paying interest to others? What is the big advantage of having a life insurance contract and practicing the infinite banking concept when what's such a big deal, and this kind of ties into the last question, is we're avoiding paying interest to others, and why is that so powerful?
Yeah. I have a client, right now his interview's on my LinkedIn portfolio because he's an engineer and he has 3 children. His wife is a physician and they're sending their kids to private school. Mm-hmm. And when we started adding up the lost opportunity cost of private school between now and the time that those children reach age 18, guess what the next cost is going to be? College. And so they're hurting the longevity of their own portfolio. So just arbitrarily, I said, if instead of you sending away hundreds of thousands of dollars and having nothing 18 years to show for it, except your kids have great educations and they're perfect children. Are you?
They all
They're
are.
Smart, maybe?
Everyone's kids are perfect.
Nobody's perfect. But they have a better education and you're happy for that to set them on a better path, a better financial flight path. There you go, a life path. So you spent, let's say, $1 million. I don't know, 3 children, close to that, and you have nothing to show for it except for that. Or you spend $1 million and you still have $600,000 left over. Which position would you rather be in?
Yeah.
And that's what you do with infinite banking because you're reusing that dollar. And so we adjusted some things. You asked, how do I find the money? 401ks over the match, how they're paying for their mortgage. Let's look at their property and casualty and auto insurance to see that they have protection, right? Enough liability so if they were sued, nothing would be taken. But also how they're paying for credit. And a big thing was how they're paying for the kids' education. They were doing it monthly. First thing I said is, what if you pay for it annually? They give you a discount? And they do. And then the next thing was, they had sold one house and bought another house, and so they had a big chunk of money. What are we going to do with that money? Well, let's capitalize that money so that it will be there instead of paying down a mortgage, right? A lot of people want to not have a mortgage.
Yes.
But you got to pay to live. And if the mortgage can be half of the cost and you're able to save the difference and you're able to save it in a cash value life insurance when you wake up 15 years from now and that money's there, your home equity may or may not be greater than it was when you purchased it. You don't know that for sure.
Right.
But you know, just as you said, Jared, or John, maybe when our cash values never went backwards. They're always moving forward. And so I have, when I help them find that money, they capitalize that money. Then we leveraged it to pay for the college, and now they're paying what they were paying for the school, a percentage of it paying back that loan and a percentage of it buying paid-up additions. Now why? If I just pay back the loan, all they're going to do is recirculate their money, nothing new.
Right.
But they were going to have a debt at the end of all of this. It was a debt they would never see. It was an invisible debt because money would not be there. So if they wake up 18 years from now and they have capital of $1 million of cash value and a loan against that cash value of $400,000,
Yes.
they got 600 more than they would have had otherwise. And man, along the way, their family was protected for, God forbid, if one of their parents passed away. We set up trusts. They didn't, really understand the need. Or they understood the need for the trust, but it was procrastination, right? Mm-hmm. We'll get to it.
For sure.
But it's just, I help people to get to it. Let's overcome that.
The getting to it part, Gina, you talked about kids and the impact on down the road on the monies that were available inside the life insurance contracts. Why do you think it's so important to include insuring kids in that whole paradigm?
Well, insurable interest for one. Do you realize that it's more likely a child will die before the age of 18 than a parent will die after the age of 35? I mean, the likelihood of that, right? That's why children get non-smoker rates. You can't get a select, non-smoker rate for a child because there's so many risks. So one would be insurable interest on that child. The second thing would be, and I get people tell me this all the time, well, I want to put the policy on my child and not on myself. Again, going back to your airplane analogy, you put your oxygen mask on before that of the person sitting next to you or your child when you're in danger. You have to have yourself insured first to be sure that if something happens to you, what you want to have happen will happen. Now, once you're insured, you can get half of the. If I have a death benefit of $1 million, my children could have 500,000. Generally, across the board for most life insurance companies, it's called adverse selection. They don't want you to buy a policy that you're going to get paid on because somebody's going to die, right? And so they don't want a child to have more life insurance than a parent. Because parents have been known to kill their children.
That's a terrible thought, huh?
But that's what the insurance companies see it as.
Well, they're excellent risk mitigation. That's their business.
Yeah. So you have to have it on yourself, but then having the policies on the kids and you own them. You own those policies until you're ready to give them over to those children, whether it's at your death or at your retirement or at the time that they believe that you believe that they're understand enough about how to keep that policy moving forward and build more for their children, then you can send that ownership over to them. Now, think my clients for a minute, right? Yeah. They were going to give away all of that money. And the policies are on themselves, but they're getting ready to buy policies on their children. They haven't done that yet. But they are. The children are insured on their group term insurance through work. So, but those are steps that we take in time. But when people want to insure the kids, they'll own the policy. They'll help the children to utilize the policy to their best interest, the children's best interest. And if the parents need to utilize it for their own best interest, then they can utilize the cash values and pay themselves back.
Without restriction.
So I think that having policies on children are after you have policies on yourself and after you've established what your goals are, and definitely instead of a 529 plan. And I've recently been talking to my clients about the Trump accounts. All right, that's the new thing. Children born between 2025 and 2028 are going to get a $1,000 deposit. Now, from everything I've read, advisors such as myself who do help manage money cannot manage that money yet, right? It's going to be managed by a government buying ETFs in the S&P 500, right? So somebody's getting paid for that. Yeah. I mean, they're going to have another government entity. What does Nelson call them? Snakes and dragons?
Right.
But it's free money if you do have a child born between 25 and 28 to get $1,000 and let it sit in the stock market.
Just begs the question, am I going to add to that? And I can't see why you would put money there versus other places.
This is a unique little thing, John, that you say that. Because you can only put $5,000 in. A parent or a grandparent can only put $5,000 in. But an employer can contribute to those accounts for their employees. So if an employer contributed their max, I think is $2,500 to that, the employer is getting a tax write-off, and it's a benefit for the employee
the child,
and the child. And you don't have to, by the way, the free $1,000 only goes to children born between 25 and 28. That doesn't mean that other children can't buy into a Trump account. They can. Now, from what I understand, when grandparents and parents buy in, this isn't decided yet if it's a pre-tax deduction, right? It appears that it's going to be an after-tax contribution, which is like a 529 plan.
Right.
So here we are putting after-tax money into accounts every year for 18 years. We don't know if the government's if the government's running that portfolio and you can't run it for yourself, that's not good, right? So you may or may not wake up with $1 million 18 years from now, as they say that you would, right? And then part of it will be pre-tax and part of it will be tax-free. And then it comes to the rules of non-qualified annuities, blah, blah, blah. First-time home buyers, IRA regulations. So is it a good thing? It's good and bad. If I had a grandchild born between 25 and 28, I'd say sign up for a Trump account. Why not? I got nothing to use. It's free money. As for contributing to it later on, let's compare that to contributing to cash value life insurance. And again, John, when we were talking about rate of return in the stock market versus this piddly little life insurance that continues to grow, I'm sure between now and the age of 18, those kids are going to need different things for their sports, for their, everything else that they do. And when the parents run out of money, and if they had to fall back on that 529 account or fall back on any of the other accounts, when I said you got to make a decision where you're going to pull the money from, they could be impeding their kids' future, So it comes back to the philosophy of liquidity, use, and control. Government out of our back pocket. Sometimes we have to deal with these types of accounts, but make sure that if you're dealing with one of those types of accounts, it fits with what you want to have happen 5, 10, 15, 20 years from now. So I'm not saying no, I'm not saying yes, I'm just saying understand what you want.
Right. No, I
understand
think
what you have to pay to get out of it.
I say very well put, Gina. And most people, 99% of the people out there that are listening to this, all this is going to be brand new to them. They may have heard of a Trump account, for instance. They don't know it. They don't know what this stuff is. Mm-hmm. But life insurance is so simple. It's so straightforward. You set it up, and it's like the old combustion engine. You turn the key, it fires up, and you go. It works. And
and this is funny. The life insurance is in your name. Right, you've got people who hate Trump and people who love Trump.
Right,
but that name is always going to be on your account. You know what I'm saying?
So if you really don't like Trump, call up Gina and set up a life insurance contract with her, for heaven's sakes. Well, it brings me to one of my final questions to you, Gina. I was thinking about, we've all had the experience of people gobbling at us for information, and then they say, I can do this myself, I don't need you. Or they'll go on the internet and they'll outsource your information to someone else, and they'll have, my brother-in-law who has a life insurance license can sell it to me. Where are the pitfalls there? Why should they come to you instead of just taking a dart and throwing it at a dartboard on the internet?
Well, that's what many people do.
Yes, they do.
And so if they want to eliminate unnecessary wealth transfers and they want to talk with someone who doesn't charge them a fee, I don't know about you, John, but I tell my clients that when we talk with one another, we're going to have a relationship that's financial. I don't need to know about what you do. I'd love to hear about all your stories about where you go and things of that nature. But we're going to talk about where your cash flow is going and what it's doing for you in the future. And pros and cons of making different decisions. So my clients will call me, Gina, I'm buying a car, I'm changing in my lease, or Gina, I had a roof, or I'm going to buy a new place. And then we strategically look at how they're going to make that purchase or pay for that item.
Right.
And it always revolves around their cash value life insurance. Now, do I charge them $150 an hour to talk to me to find that answer? No. Do they need to spend 3 hours on the internet searching what might be the right solution by 6,000, maybe 600,000 AI responses? I don't know. No. It's a quick telephone call and looking at what they have, not looking at what everybody else has, what everybody else is doing. I think that's the big thing. We're all doing something in our lives, but it's a little bit different because we live a little different lifestyle. Some people have kids, some people don't have kids, some people have dogs, some people have cats. So sometimes I think their pets are more expensive than having children. So, I mean, everybody has a different lifestyle. Some like to snowmobile, some like to ski, some like to, play golf, just go on vacation. My husband and I now, we travel in our RV during the winter to get away from the snow. We were here in Florida, and we did get away from the snow, but not the cold this year. But
Now, we do just the opposite. We fly to the snow to go skiing. So we're
well, this is what I'm saying. Everybody has something different that they like to do, and so helping them do what they want to do is what I do.
Well, very
Achieving
well.
goals.
Yeah, very, very well said, Gina. And just kind of to sum things up, Gina, we're so grateful that you took the time with us here on Creating Tailwinds, Flight Path Financial. Gina's company is Financial Design Strategies, and you're in Michigan, and where?
My office is in Michigan, but I am licensed in probably 20 different states. And how I got licensed in those states are referrals from people. Once we got started, you got to talk to my friend, and so they, of course, lived in a different state. And so I get licensed so that I can talk with people in the states that they live in. And if they live in a state I'm not licensed in and we choose to do business together, I just get licensed in that state.
That's right.
Pay a fee.
And just so everybody knows, Gina has been doing this longer than I have by a long shot. I think I met you back in 2017, 18, somewhere in there with Nelson. Yeah. And Gina was doing presentations, and if you've never seen a presentation that Gina has done, you're missing out, because she does a phenomenal job, and it's so informative. And her clients are lucky to have her. And anybody out there listening, if you want some solid guidance, where Gina does business, and she does do business in all 50 states if you ask her, and she will. So, with that, we thank you so much, Gina. And
John, I appreciated the offer to come onto your show.
Pleasure, absolute pleasure. And I'll thank you for Jared. We lost. Jared was on assignment, traveling, and he.
Yeah, that's okay. Well, I said, I'm here in my mom's spare bedroom, and we're in Florida and enjoying the weather here today, and go out and do little fun things this afternoon and enjoy the weekend.
Awesome. Gina, so nice to see you. And
too,
we
John.
wish you a wonderful, wonderful day. And again, thank you for your graciousness and your kindness and hospitality being on with us.
Thank you for asking.
Thank you.
Mm-hmm.
Of course. All right, everyone. We're going to sign off with Gina. Give Gina a call at Financial Design Strategies. And what's your website again, Gina?
It's www.yourfds for financialdesignstrategies.com, or call me at 810-579-5808.
There you have it, from one of the best in the business. Gina, thanks a million.
You're welcome.
All right,
Thank you.
Have a wonderful day, Gina. We'd like to thank you for tuning in to today's episode of Creating Tailwinds podcast with your hosts, John and Jared. As always, we welcome your questions and critiques. You can reach us through the Contact Us tab at flightpathfinancial.com. Remember, it's all about how you think. As Nelson Nash has said about infinite banking, give it your close attention, and it can make a radical improvement in your financial future.